Hey there. So, electric vehicles are like the superheroes of transportation, right? They're all about saving the environment with lower emissions, keeping your wallet happy with reduced maintenance costs, and zooming around town with some serious performance. But here's the scoop. Diving into the electric vehicle business is no walk in the park. It's like trying to launch a rocket. You need a bunch of cash, a sprinkle of innovation, and a whole lot of trust from customers. Now, check this out. Even big players like Tesla, the cool kid on the EV block, faced some serious money bumps in the past. And guess what? Rivian, the new kid on the block, is kind of sailing in the same boat. They've been delivering those snazzy electric trucks for almost 2 years now. But here's the twist. They're burning through money like it's going out of style. On the upside, Rivian had a rockstar third quarter. They're set to roll out 52,000 vehicles this fiscal year, beating their own expectations. Impressive, right? But here's the plot twist. Behind the scenes, there's some worry. Despite the fancy deliveries, analysts are raising eyebrows because Rivian seems to be losing about $33,000 for every R1T pickup truck they sell. Ouch! It's like a roller coaster of good news and not so great news. Rivian's got the cool features that make heads turn, like the tank turn that spins the vehicle 360 degrees in one spot. But, and there's always a but, those losses are creeping up because of the high costs of production, research and development, marketing, and customer service. So, buckle up, my friend, as we dig into why Rivian's burning through cash faster than a race car on the track. So, Rivian isn't just cruising through the electric vehicle scene, it's also navigating a competitive race with heavyweights like Tesla and Ford. Talk about a tough neighborhood. At the beginning of this journey, Ford was like Rivian's cool partner, investing $500 million in them back in 2019. There were big plans to use Rivian's skateboard platform for Ford's future models. But plot twist, Ford decided to go solo, crafting its own electric vehicle platforms tailor-made for their brand, especially for the F-150 Lightning pickup truck, which is eyeing a showdown with Rivian's R1T. This change-up not only altered Ford's game plan, but also signaled a shift in Rivian's trajectory. Ford took a step back financially, selling some of its stake to Amazon, another major player in the Rivian saga. Oh, and don't forget the departure of Rivian's chief operating officer in July 2023. Yep, it's been a bit of a roller coaster. Now, here's the face-off. Ford brings its loyal customer base, a strong brand rep, and a massive network of dealerships to the table. Rivian counters with innovation, attractive products, Amazon's backing, and a cool direct-to-customer sales approach. But hold on, the race isn't just about who's got the cooler features. They both face the Herculean task of meeting high demand, slashing costs, and ramping up the quality of their EVs. And about those losses, Rivian spilled the beans in its Q2 2023 financial report, a whopping $33,000 loss per vehicle. Ouch! Despite raking in $1.12 billion in revenue that quarter, they found themselves in a negative gross margin zone of 29%. Blame it on the high costs of launching those initial vehicles, production capacity, new staff, and loads in research and development. Sure, Rivian's optimistic, expecting the gross margin to shine as they expand, cut costs, and introduce new goodies. But some skeptics in the analyst and investor crowd aren't entirely convinced. They're eyeing the fierce competition, the pressure to meet sky-high expectations, and the global chip shortage causing ripples in the automotive industry. Here's the kicker. Rivian's the talk of the town, valued at over $100 billion as of October 2023, securing more than $12 billion in investments from heavyweights like Amazon and Ford. But hey, not everyone's cheering in the crowd. Some critics say, show us the real deal. You've only delivered about 20,000 vehicles so far. The spotlight's on, and Rivian's got some proving to do. Now buckle up for a financial roller coaster with Rivian. Despite slapping an $80,000 price tag on each of their sleek vehicles, they're facing a pretty hefty financial hurdle. Picture this, a loss of around $33,000 per unit, and the Wall Street Journal just shone a spotlight on the rising production costs that are giving Rivian a run for its money. Now, here's the plot twist. While Rivian aims to keep that $80,000 tag per vehicle, the average selling price of EVs in the market dropped to around $53,366 in August 2023. Talk about navigating a challenging landscape. Rivian's game plan focuses heavily on crafting top-tier trucks and SUVs, making up a whopping 83% of their total sales. It's a bold move targeting the premium market, but it's also biting into their financial pie due to the hefty investments needed for these high-end electric vehicles. The struggle is real, my friend. The Wall Street Journal spilled the tea, revealing that Rivian burned through half of its $18 billion cash reserves in just 2 years. Ouch. Limited production capacity in their Normal, Illinois factory and the hefty costs of sourcing specific components are like financial hurdles on the racetrack. But hey, there's a light at the end of the tunnel. Production at the Normal factory is revving up, potentially easing some financial strain. The big boss, RJ Scaringe, isn't sitting idly either. He's slashing costs and streamlining operations like a financial superhero. And guess what? It's starting to pay off. Losses are narrowing. As of June, Rivian was still grappling with expenses, surpassing a cool $1 billion per quarter. That's no small change. But here's the twist. That $33,000 loss per vehicle might make you raise an eyebrow, but compared to previous quarters, it's actually a considerable improvement. The loss margin per vehicle, now at 37%, is a significant drop from the first quarter when they were bleeding nearly double that amount, around $67,341 for each vehicle sold. Progress. But here's the kicker. One analyst, Colin Langan from Wells Fargo, is raising an eyebrow. He's not entirely convinced that Rivian's cost-cutting measures alone will cut it. He's suggesting they might need to do a bit of a strategic dance, like tweaking those vehicle prices. The road to profitability for Rivian is a bumpy one, and it's got the financial world watching with popcorn in hand. So here's the scoop on Rivian's financial journey. It's been a bit of a roller coaster ride. One key factor in the recent shift in their financial landscape is the drop in the number of vehicles delivered in the early part of 2023. If we rewind to the last quarter of 2022, when Rivian was rolling out more vehicles, they still faced a substantial loss of $124,600 per unit. Yikes. Now, as we dive deeper into their financial data, the overall picture is a bit less rosy. Sure, Rivian has made strides in cutting down losses over the past few quarters, but the road to financial glory is a winding one. It highlights the importance of cost-cutting measures in the pursuit of profitability. Finding that sweet spot between manufacturing costs, scaling up production, and sales volumes is a make-or-break dance for any automotive company. The real test, the upcoming third quarter financial results, set to drop on November 7th. This will be the moment of truth, giving us a clearer picture of whether Rivian has continued to narrow its losses and how close it might be to dipping into its remaining cash reserves. The goal? Profitability by late next year. We've got our eyes peeled, ready to dissect Rivian's financial outlook. Stay tuned for updates on this financial saga once those quarterly results hit the stage. But hey, we're curious, what's your take on all this? Drop your thoughts in the comments below. Don't forget to hit that subscribe button so you won't miss out on anything important. Thanks for watching and see you next time.